Okay, hi everyone. Just testing to see if everything's working. Okay, hi everyone. Welcome to today's webinar brought to you by Vantage. We're gonna do Can the US keep borrowing forever? This is a topic that I think a lot of you will find interesting, and a lot of you may have thought about this or ponder on this before because I mean, we saw all of this happening during COVID, right? They were printing money like crazy. They were giving out stimulus packages, and they just keep printing money like it's free. So the question now is, can they keep doing that? And what are the repercussions? And what's going to happen if they do keep doing that? Okay. Again, just checking. Hi, Karsten. Hi, Tiffany. Thank you, Tiffany. Thank you, Matthew, Tessa, Helen, Eula, Shin, Ron, Shala, Sean. Hi, Adam. Hi, Muhammad. Hi. No worries. You weren't late. We haven't even started yet. Okay, let me go on to the next slide. Oh, so this disclaimer, you guys know how this works. Anything that I share in this webinar should not be construed as educational advice, any form of financial advice, or any form of signal to buy or sell. I am not here to give you guys that kind of advice. I am just here to share my knowledge, and then you guys implement it into your own trading style, your own investing style, okay? Please don't take it as me giving you any signal to buy or sell, okay? And also another risk warning, trading Forex and CFDs, especially if you are trading on high leverage, do carry significant risk and may not be suitable for all investors, okay? You may lose more than you intend to. So please, um, be cautious. Don't jump into the water before learning to swim. Other than that, I do have to stay here for a minute or two so that you guys can read through the disclaimer on your own, and then we will start today's webinar. Okay, cool. I see 1,200, 1,300 of you tuning in from Vantage app. So if you ask me a question and I miss your question, just know it's because there's a lot of you tuning in. Okay, and the chat box is moving a lot quicker than it is on Zoom. If you're tuning in from Zoom, I usually don't miss your questions. Okay, so that is 1 minute or 1 or 2 minutes already, I think. Um, I think everyone's good, right? You guys should be able to read through the disclaimer on your own. I'm going to continue with introducing your host. So my name is Cassandra. I'm an investment analyst from Everest Fortune Group. We are a research firm that is based in Singapore, and we have been recognized as the finalist for the best Forex and the best equity research for multiple years running. What we do here is a lot of backtesting, a lot of research, a lot of forecasting, a lot of understanding where the markets are moving, and just understanding Forex, crypto, stocks, whatever it is. That is our job to kind of study it thoroughly. So because we spend so much time on the markets and on the charts, I am also a prop trader. For those who don't know what prop trading means, it means that I am funded by multiple companies to trade their funds. How did I get this funding? I did 10% profit within a month multiple times. Okay, so I had to take a test, and that was the requirement that they needed. So I've done that many times. How did I do that? I combine fundamental analysis with technical analysis. I used to only do technical analysis, but I've recently combined fundamental analysis as well. And that brought my trading to even higher probability and higher profitability. Okay, so this part, every week I'm doing fundamental analysis for you guys. That means like news, the economy, geopolitics, whatever it is regarding the related to the economy, I'm the one doing it. So I hope it helps you guys see the markets in a different point of view. I hope it helps you become more profitable, right? And yeah, that's it. Okay, so our agenda for today is to understand how fiscal policy affects bond yields and the US dollar, the debt ceiling drama, and what it really means. Investor confidence and safe haven demand, and trading opportunities during US fiscal events. Okay, so the big question is how is US printing money and can they continue doing it? So, how fiscal policy affects bond yields and the US dollars? Let's understand this a little bit. Just give me a moment, guys. Okay, so when people talk about the markets, they usually focus almost entirely on central banks. Sorry, I got the topic wrong. In my mind, it was like the US was printing money. It's not about them printing money, it's about the borrowing. Okay, so today's topic is about borrowing. It's not about how they constantly print more money. Um yeah, so back to the topic. So yeah, they usually focus almost entirely on central interest rates, inflation, and liquidity. But in the background, there's always another force that has become just as important, if not more so in recent years, which is the fiscal policy. Fiscal policy is basically how much the government spends, how much it taxes, and how much it borrows to cover the gap between the two. And when the borrowing becomes a very large and very persistent, it starts to directly affect bond markets and currencies. The US is a perfect example. For years, markets could largely ignore fiscal deficits because inflation was low and the Fed was absorbing a lot of government debt through quantitative easing. But once inflation surged and the Fed stepped back from the buying bonds, fiscal policy suddenly became very visible to markets. The US Treasury had to issue massive amounts of debt to fund deficits, and investors started demanding higher yields to absorb that supply. This is crucial. This is a crucial shift for traders to understand. Bond yields are no longer just about inflation and Fed policy. They're also about supply and demand for government debt. When deficits are large, more bonds are issued. If demand doesn't keep up, yields rise, and when yields rise, that feeds directly into forex, equities, and global capital flows. So when we ask, can the US keep borrowing forever? The market isn't answering philosophically, it's answering through prices. Higher borrowing pressure shows up as higher yields, more volatility, and changing US dollar behavior. Fiscal policy has moved from a background issue to a front row driver of markets. Okay, so let's understand why bigger deficits often means higher yields and even issuance will increase, okay? And see what I'm like, have a reference of what I'm talking about. So it's always on the left, sorry, right side. The bottom right of the screen of on my slide is usually where I leave the side notes for you guys to read off, like reference off. Okay, so one of the biggest misconceptions traders have is thinking that bond yields only rise when inflation is high. Okay, that's not entirely true. Okay, in reality, yields can rise even when inflation is stable, simply because the government is issuing too much debt. This is where fiscal policy directly collides with the bond market. When the US runs large deficits, the Treasury has to issue more bonds across the curve, short-term bills, notes, and long-term bonds. That increased supply has to be absorbed by someone. So banks, pension funds, foreign investors, or households. If demand is strong, yields stay contained. But if demands weaken, yields rise until buyers are willing to step in. Okay, so far so good, right? I think that's easy to understand. So that extra yield is called term premium. Compensation investors demand for holding long-term government debt. In the post-2008 world, term premium was suppressed because central banks were massive buyers of bonds. But today, central banks are either neutral or shrinking their balance sheet. That means private investors must absorb more supply and they're more price sensitive. As a result, fiscal deficit now translate more directly into higher yields. For forex traders, this matters because higher yields usually support the USD, at least initially, as global capital flows into US assets for better returns. But over time, if yields rise due to fiscal stress rather than growth, the story can flip. Rising yields driven by fiscal concerns can eventually undermine confidence, creating volatility in both bonds and the dollar. So, fiscal policy doesn't just affect yields mechanically, it affects the quality of yield moves. Are yields rising because growth is strong or because borrowing is excessive? Market care deeply about the difference. Okay, so let's understand a little bit about the US dollar reaction when fiscal strength supports the dollar and when does it not support the dollar? Okay, when it doesn't. Okay, so the relationship between US fiscal policy and the dollar is not linear. Okay. And this is where traders need to be careful. So in the short term, larger deficits and higher yields often support the US dollar because global investors are attracted to higher returns. Okay, that's very normal. If you're an investor, obviously you would go for the higher returns. Okay, so I mean, if you think about it, this is why paradoxically the dollar can strengthen even when the US debt is rising rapidly, right? But over the longer term, the US dollars becomes a confidence trade. Investors start asking tougher questions. Can this level of borrowing continue without inflation? Because I mean, I myself do think about this a lot. Like, how can they keep doing that? Like, why is it they can keep doing that? Will foreign investors keep funding the US deficits? Will fiscal dominance eventually pressure the Fed to keep rates lower than inflation would justify? And these questions don't move markets overnight, but they shape medium and long-term trends. Okay, so this is why you sometimes see a strange mix. Strong US dollar during periods of stress, but growing structural debate about its long-term trajectory. So the dollar still benefits from the safe haven status and deep capital markets, but at the same time, fiscal sustainability becomes a background risk factor that can amplify volatility during crisis. So for traders, the key insight is this. Fiscal policy strengthens the US dollar when it boosts yields and safety demand. But it will also weaken the US dollar when it undermines credibility. Knowing which phase you're in helps you avoid simplistic assumptions and trade USD more intelligently during fiscal-driven market moves. Okay, so far so good. Anyway, I put a photo here of the US dollar trend over the last 50 years. Okay, you can see how it is um moving up. It's moving up and then moving down. Okay, there are always going to be risk if they borrow so much, and if they continue to borrow, there's always going to be repercussions. That's very normal and very valid. Okay, so let's continue with the debt ceiling drama, what it really means. Okay, um, in my opinion, at least, right? I think the debt ceiling is a lot of political theater, not okay, it is not a solvency crisis. So every time the debt ceiling comes up, you will see headlines that make it sound like the US is about to go bankrupt, right? Have you guys, like, I'm sure with like social media and whatnot, you guys have seen something. Oh, the US debt ceiling is like increasing, blah, blah, blah. The economy is not doing well, blah, blah, blah. Okay. That may not be entirely true at all times. And markets briefly panic as if the world is ending. But let's slow down and separate theatrics from reality. The US debt ceiling is not about whether the US can afford its debt. It's about whether Congress authorizes borrowing to pay for spending that has already been approved. Okay, so the US government does not suddenly run out of dollars the way a household runs out of cash. The US issues debt in its own currency, controls that currency, and has deep global capital markets willing to fund it. Okay, so there's a lot of things. I mean, I personally saw and heard about the US debt ceiling for the first time when I was on social media, right? So on social media, there's always like a lot of things that are going around, a lot of information that are going around that may not be very accurate information or maybe like oversimplified or more dramatic than it should be. So the US debt, like I said, is not like a household, right? If I run out of money, I would be in trouble. You know what I mean? Because where am I going to get more money? But for a country, right? For the US government, it's not the same. It doesn't just run out of money the way that we run out of money. So the US, like I said, issues debt in its own currency. So it can print money if it wants to. Okay, it's just that it may cause a bit of inflation, it may cause a lot of problem, but it can. It's never really in a lot of trouble. Okay, so from a solvency perspective, the US is not comparable to just any emerging market or a household with a maxed out credit card, for example. Okay, this is why every debt ceiling standoff eventually ends the same way, with a deal, a suspension, and a temporary extension. So why does the drama matter at all? Because while default is extremely unlikely, okay, it's extremely, listen clearly, it is extremely unlikely, market stress is still very real. Okay, so Treasury cash balances fluctuation, bill issuance gets distorted, money markets become uneasy, and short-term funding rates can spike. These micro stresses don't mean collapse, but they do create volatility, especially at the front end of the yield curve. So for traders, the most important thing to understand is this. Debt ceiling episodes are not existential. It's not an existential crisis, okay? They are volatility events driven by political uncertainty. and the markets price uncertainty aggressively, even when the worst case outcome never happens. Okay, so please remember this. Debt ceiling episodes. Okay, when you hear the news, when you read somewhere, you heard something about the debt ceiling is expanding or blah blah blah, it's getting hit or whatever it is. Debt ceiling episodes are not, they're not dramatic crisis. Okay, they are a volatility event driven by political uncertainty. Okay, it's just a temporary political uncertainty. Okay, so where the real stress shows up, um, when there is stress, T-bills, money markets, and liquidity. Okay, so the real impact of the debt ceiling doesn't show up where most retail traders look. Okay, um, I put a table here, but we'll look at this in a bit. Okay, we'll kind of understand this in a bit. Okay, so it start in equities and long-term bonds. It starts in short-term treasury bills and money markets. This is where plumbing of the financial system lives, and this is where stress becomes visible first. When the Treasury approaches the debt ceiling, it can't issue new debt freely. That forces it to draw down its cash balance at the Fed and juggle payments. At the same time, investors become cautious about holding T-bills that mature around X date. Okay, the when Treasury could temporarily run out of authorized borrowing capacity. That caution pushes yields higher on those specific maturities, even if longer-term yields are stable. This is a critical nuance, okay? Yields may rise not because investors suddenly believe the US is riskier long-term, but because technical liquidity concerns make certain instruments less attractive. Money markets fund adjust allocations, bank manage balance sheets defensively, and funding rates can become volatile. Once a deal is reached, this process reverses. The Treasury floods the market with new issuance to build its cash balance, which can temporarily drain liquidity from risk assets. This is why markets sometimes react after the debt ceiling is resolved, not because the news is bad, but because the liquidity mechanics shift abruptly. Okay, so for traders, this means the debt ceiling events are not it's not a one-day story. Okay, they create multi-phase volatility, stress before resolution, relief at resolution, and liquidity adjustment afterwards. So understanding those phases give you an edge over traders who only react. Okay, so, oh, sorry, let's go and understand this. So, this how it usually, what it would kind of look like. So if the financial system is feeling stressed, what will get affected is the forex market, the funding markets, the credit market, real estate market, equity market, securities that will feel it. The currencies will start crashing, okay? Um, Covered interest spread, okay? And then we've got financial beta, interbank liquidity spread, interbank cost of borrowing spread, bank bond spread, it will all increase, okay? It will get worse, okay? And you know who suffers every single time? It's always the end user. Okay, so then the credit market, so the corporate bond spreads, liquidity spreads, treasury yield curve spread, CPT will spread, it will all get worse and wider. And then we've got the residential and commercial real estate. It's just gonna get bad. Okay, and for equity, we've got the stock sector. It might crash, it might drop, but it will get affected. And securitization, that doesn't really, I personally am not someone who invests in that. Okay, but yeah, these are the ones that will be affected as well. Okay, so let's move on to why markets care even when default never really happens. Okay, so one of the most common questions traders ask is if default never happens, why does the debt ceiling matter so much, right? I'm sure you guys have asked this question before because I certainly have asked this question before. I certainly have wonder myself, like, why do they keep talking about this debt ceiling thing when it doesn't really ever affect the economy anyways, right? So the answer lies in confidence and perception. Okay, not actual credit risk. Markets don't need catastrophe to move. They just need uncertainty about rules and governance. History gives us a perfect example. In 2011, the US did not default, okay? But it did get its credit rating downgraded. The markets reacted violently, equities sold off, and volatility spiked. And paradoxically, the US Treasuries rallied as investors sought safety. That tells you everything you need to know. Markets were stressed about governance, but still trusted the US system more than alternatives. Debt ceiling standoff reminds investors that political dysfunction can interfere with financial operations, even if the probability of default is tiny. The tail risk is uncomfortable enough to reprice assets temporarily. This is why you see safe haven demand for USD and treasuries during the worst moments of the drama, followed by normalization once clarity returns. So, for Forex traders, this creates a very specific dynamic. The US dollar can strengthen during debt ceiling stress, not because fiscal health is improving, but because global risk aversion rises and liquidity preference dominates. Then, once the issue is resolved, the market refocuses on fundamentals like deficits, issuance, and yields. So the debt ceiling is not about whether the US survives, it's about how confidence is tested, okay? How liquidity is disrupted and how markets temporarily reprice uncertainty. So if you understand that, the headlines stop being so scary and start becoming tradable. Um, I always had this rule not to believe things other than like data releases. So if you see like sometimes you see like Bloomberg, Forbes, or whatever it is, financial news, Business Times, okay, coming up with all these weird headlines, I think it's a lot of like fear mongering, right? It's a lot of like scaring you. You're like, okay, a lot of times I read this in the news, I'm just like, oh my God, the economy's gonna crash, the economy's gonna crash. And actually it ends up like things never actually happen. So there's a lot of like fear going around. I think what you guys should do is not read too much into those, but what you can do is to focus more on the data releases, like the actual things that matter, the actual releases like PPI, CPI, unemployment rates, and whatnot, right? So central bank interest rates, whatnot, but not so much on headlines. Okay, so investor confidence and safe haven demands. Let's understand a little bit about this. So what investor confidence really means in the financial markets? Let's see. So when we talk about investor confidence, many people assume it simply means whether investors feel bullish or bearish. But in macro markets, confidence is something much deeper and much more structural. Investor confidence is really about trust in the system, trust that contracts will be honored, payments will be made on time, and rules won't change unexpectedly. And policymakers will act rationally under pressure. This is why markets can remain relatively calm even during weak economic growth. but react violently during periods of political dysfunctions or policy uncertainty. Growth can be slow, inflation can be uncomfortable, but as long as investors trust the system, capital stays put. Once that trust is questioned, even temporarily, risk premiums rise across the board. Okay, so in the context of US fiscal debates, confidence isn't about whether the US has enough money, it's about whether the political system can function smoothly enough to manage its finances without creating unnecessary shocks. Debt ceiling standoffs, government shutdown threats, or aggressive fiscal brinkmanship all test that confidence, not because default is likely, but because they introduce uncertainty into what is normally considered the safest and most predictable market in the world. So for traders like you and I, what does that mean? Okay, this matters because we should pay attention. And it does matter because confidence doesn't disappear evenly. It leaks out in specific places first. So funding markets, volatility indices, safe haven flows before it shows up in broader risk assets. So if you know where to look, you can see confidence eroding or stabilizing long before headlines catch up. Okay, so I've put an example here. So investor confidence, you need to determine whether it's high confidence or low confidence. Okay, if it's high confidence, you will have a stable market and growth increased risk appetite. Okay, that's very normal. If it's low confidence, then you'll have reduced investment and market volatility. Okay, so let's understand why the USD and treasuries still win during confidence shocks. Okay, so one of the most counterintuitive things that for newer traders is seeing the US dollar and US treasuries rally during moments when the US itself is at the center of the problem. Debt ceiling drama, credit rating downgrades, fiscal concerns, and yet money still flows into the US dollar and treasuries. This means illogical until you understand one key idea. Safe haven demand is always relative. In times of stress, investors don't ask what is perfect, okay? They ask what is least bad and most liquid right now. And despite its flaws, the US still offers the deepest capital markets and most liquid government bond market, and the world's primary funding currency. When uncertainty rises anywhere in the global system, demand for the US dollar liquidity increases, not decreases, right? You guys notice that? Okay. This is why the US dollar often strengthens during global stress events, even if those events involve US politics. It's not a vote of confidence in fiscal discipline. It's a reflection of the dollar's role as the backbone of global trade, finance, and debt markets. Okay, so similarly, treasuries rally because they remain the benchmark risk-free asset for collateral margin and balance sheet management. So for Forex traders, this creates an important distinction. Short-term stress supports the US dollar through safe haven flows. Longer-term fiscal concerns may weaken the USD through credibility erosions, but those forces operate on very different timelines. Mixing them up is one of the biggest macro trading mistakes that you can do as a trader. Okay, so when confidence cracks, become tradable market signals. Okay, so investors' confidence doesn't vanish overnight. It fractures in stages, and those stages leave fingerprints in the market that traders can learn to recognize. The The first signs usually appear in volatility measures and short-term funding markets. You'll see spikes in implied volatility, unusual moves in front-end yields, or distortions in money market pricing. These are early warnings that stress is building beneath the surface. Next, you'll often see selective safe haven flows, not a full-blown panic, but subtle strength in the US dollar, in the Japanese yen, or short-term dated treasuries. Equities may still be holding up, but defensive positioning starts creeping in. This is the phase where smart traders reduce risk, tighten exposures, or position defensively, not because disasters is imminent, but because confidence is no longer abundant. So, the thing is, if confidence deteriorates further, that's when broader risk assets react. Equity indices sell off, credit spreads widen, and correlations across markets tighten. By this stage, the move is obvious, and the best risk-adjusted opportunities are often already gone. So, the edge lies in recognizing confidence cracks early, not panicking, not predicting collapse, but understanding that markets are repricing uncertainty. For traders, especially in Forex, this means watching how safe haven currencies behave relative to risk assets, not just whether headlines sound scary. Confidence is invisible, but its effects are very tradable if you know where to look. Okay, guys, we're going into our last subtopic for today, which is trading opportunities during the US fiscal event. Okay, once we are done with this, I think we should be left with about 10 minutes. We can use the last 10 minutes to do like a Q&A session. But that being said, if you guys have questions for me right now, you can just ask me right now. Okay, you don't have to ask me later. If I see it, I'll answer it again. Those who are on Vantage app, you know that the chat is moving like crazy. Okay, so why US fiscal events create tradable volatility even without crisis? Um, One of the biggest misconceptions traders have is thinking that the US fiscal events only matter if something breaks. Okay, in reality, markets don't need an actual crisis to move. They move on uncertainty, deadlines, and probability shifts. The US fiscal events like debt ceiling debates, budget negotiations, shutdown risk, or large deficit announcements consistently create volatility because they introduce uncertainty with like into what is normally considered a very stable part of the global system. Okay, so what makes these events tradable is not the outcome, okay, but the process. Deadlines force positioning, politicians delay clarity, markets hate that. As a result, traders start reducing risk, hedging exposure, and repositioning well before anything actually happens. This creates price movements even when the eventual resolution is fully expected. Another key point is that fiscal events affect multiple markets at once, okay? It doesn't just affect one market. So the markets that are affected, things that are affected will be bonds, Forex, equities, and volatility indices. Okay, that cross-asset reaction is what gives traders confirmation. So when yields move for technical reasons, okay, when things move, for example, a higher than expected CPI, okay, which will cause the US dollar volatility events, okay, USD reacts through safe haven demand and equities wobble on uncertainty. You're seeing a classic fiscal event setup. Okay, so when trading the US fiscal events, the goal is not to predict. Sorry, I think I've got a question here. Okay, I'll come back to your question in a little bit. Just give me a little time to finish this slide. Okay, sorry, where was I? So when trading US fiscal events, the goal is not to predict collapse or default. Okay, I see more questions coming in. Okay, you know what, guys? I only have let me see. I only have two more slides after this. So let me just finish these two slides and then I'll answer all of your questions because I already see questions coming in. I see one, two, three, four, five, six questions on Zoom alone. And then I haven't even checked the Vantage app. So let me just finish these last few slides and then I'll answer some of your questions. Okay, so when the trading US fiscal events, the goal is not to predict collapse or default. The goal is to understand where uncertainty is being priced, how positioning is shifting, and which assets benefit from temporary stress. That's where opportunity lives. Okay, last two slides, guys, and then we can do our Q&A. Last two slides. Okay, last two slides. So we're gonna understand what to trade, the US dollar, yields, equities, and why timing matters. Okay, so not all assets react at the same time during US fiscal events, and understanding the sequence. More questions coming in. Okay, hi. Thanks for asking, guys. I love that we are being very interactive, and I love that you guys are asking questions. Okay, almost done. Okay, so we need to understand the sequence, and okay, it's very critical. So the first place stress usually shows up in short-term treasury yields and funding markets. That's where technical constraints and liquidity concerns appear earliest. So if you see unusual behavior in T-bills and front-end rates, that's often your first signal that the market is becoming uneasy. Next, the US dollar tends to strengthen, right? Not because the US suddenly looks fiscally responsible, but because uncertainty increases global demand for liquidity. The dollar is still the world's funding currency, right? So remember that. So when the risk rises anywhere in the system, the US dollar demand increases almost mechanically. This is why USD strength during fiscal drama does not contradict long-term debt concerns. They operate on different timeframes. Equities usually react last. At first, markets often assume this will get resolved, but as deadlines approach and uncertainty drags on, equity volatilities increases and downside risk accelerates. This delayed reaction is important because it allows traders to position defensively early instead of chasing equity sell-offs late. So the timing matters. Early phase, watch yields and USD. During the mid phase, look for confirmation across forex and volatility. And the late phase, equities catch up. So trading US fiscal events is about sequencing. It is not about speed. Okay, so this is the last slide. Okay, let's look at the practical trade setups, how professionals position around fiscal risk. So, from a practical standpoint, professional traders approach US fiscal events with a very specific mindset. Risk management first, opportunity second. This is not the environment for oversized positions or aggressive prediction. It's about positioning for volatility, not calling outcomes ahead of key deadlines. Pros often lean defensively, favoring USD strength, reducing equity exposure, or holding positions that benefit from volatility expansions. These traits don't require catastrophe, they just require uncertainty to persist. So, as long as clarity is delayed, the positioning tends to work. Once resolution becomes likely or confirmed, the strategy shifts. Markets often overprice risks going into deadlines, which creates opportunities to fade extremes afterwards. USD strengths can retrace volatility compresses, and equities often rebound sharply once uncertainty is removed. Even if the fiscal situation itself hasn't improved structurally, the most important discipline here is sizing and patience. Okay, so US fiscal events reward traders who stay flexible, avoid emotional reactions, and respect the difference between short-term stress and long-term fundamentals. You're not trading whether the US collapses. You're trading how markets temporarily reprice uncertainty. If you understand that distinction, US fiscal events stop being scary headlines risks and start becoming repeatable structural trading environments. Okay, so I'm done. Do our Q&A. Just give me a sec, guys, to pull out all your question and answer because I see questions being asked on multiple places. So give me a moment. Sorry, I just need to pull out chat box on Vantage app as well. Just give me 1 minute. I'm gonna try to answer you guys on Vantage app as well. Okay, so the first questioner is if the US keeps running huge deficits, why doesn't the dollar just collapse? Valid question. Okay, so because in short term, right, the dollar benefits from being the world's main funding currency. So when certainty rises, people don't just run from the US dollar, right? Because I think I've repeated this many, many times in like even the past webinars. Okay, they run into liquidity, and the US dollars, I mean, it's still quite liquid. So long term is a different conversation, but in short term, deficits don't automatically mean a weak dollar. Okay? Like I said, like why do the headlines matter if ultimately it doesn't really crash, right? Okay, another question I've got here. Hey, Kes, is rising US debt actually bullish or bearish for bond yields? Is rising US debt actually bearish or bullish during um to answer your question, it depends on how long. So short term, it's usually bullish for yields because more debt means more supply. Okay, but if yields rise too fast and start hurting growth or markets, demand comes back in. So it's not one directional. It creates volatility more than a clean trend. Okay, so I've got another question here. Are the websites where we can check to know status of global liquidity to know where institutions may be putting their funds, especially in times of high volatility? Are there websites? Okay, there's no single site for global liquidity, but you can check using a few indicators. Okay, so so can you just think about this? Okay, Fed balance sheet and reverse repo data on Fed show whether liquidity is expanding or tightening. Bond yields and T-bill demand will tell you where money is hiding during volatility, and ETF flow data gives clues on whether funds are moving into risk or safety. But yeah, no, there isn't one single website that shows global liquidity. But yeah, that's a very good question. I think actually someone should come up with it. Yeah, but so at the end of the day, the prices are actually the best signals. A strong USD and rising yields mean tight liquidity. Falling yields and weaker USD means liquidity is improving. Okay, I've got the next question here. So every time there's debt ceiling drama, nothing really happens. So why should we even care? Okay, very good. I think I just mentioned this. Okay, you should still care about the volatility, not so much about the outcome. Okay, the drama creates stress in money markets and positioning shifts. Okay, so even if it gets resolved, the market is still going to move and you are still going. I mean, as a trader, we trade the moves, right? We trade the moves. Okay, so the next question here is regarding confidence, loss of confidence. You said that traders can prepare if you know where to look. Can you expand on this and where, how to look for confidence level? Okay, so confidence level isn't something that you can find on the headlines. Okay, you can see it in market behavior. Okay, so the first place to look is volatility. When volatility is high, okay, sorry, let me put it this another way. When volatility is low or it stays compressed, even on bad news, when confidence starts slipping, volatility spikes on small headlines. That's a warning sign. Okay, so second is to watch out for short-term funding and front-end yields. If T-bill yields, repo rates, and short dates yields start acting weird or spiking for technical reasons, that usually means institutions are getting cautious before the broader market reacts. Okay. Third, you can look at the safe havens. Okay, so if the US dollar, the Japanese yen, or short-dated treasuries start getting bid while equities are still holding up, that's earlier defensive positioning. Confidence is weakening quietly. Okay, and I think the last one you can look for is correlation. So when everything starts moving together, like stocks down, yields volatile, US dollar up, that's usually confidence breaking, not just normal correction. Okay, so I've got another question here. How crypto markets are affected by volatility caused by issues on US debt borrowing? Crypto reacts through liquidity and risk sentiments, not directly through US debt headlines. So when the US debt or borrowing issues cause volatility, the first thing that tightens is liquidity. Um, Yields will get jumpy. US dollars demand rises, and the US and the sorry, not the US, the risk appetite drops. In that environment, crypto usually feels the pressure, okay, because speculative capital pulls back and leverage gets reduced. So if the stress turns into policy response expectations, okay, for example, like the Fed's having to step in, ease conditions or stabilize markets, then crypto can actually rebound harder, okay, because markets start pricing future liquidity again. So in the near term, US fiscal stress equals to choppier and weaker crypto. Okay. Medium term, if it leads to easier policy or liquidity support, crypto will often well it sometimes off it will benefit crypto. Okay. So that's why if crypto can sell off first, then the recovery faster than people expect. I've got another question here. Can the US actually default one day? Okay, technically, yes. Politically, it's very unlikely. Okay. The bigger risk isn't about default, right? Like I said, it's confidence shocks, rating downgrades, and liquidity stress. Markets move long before anything dramatic happens. Okay, so I think that's all the questions that I see here on Zoom. I tried scrolling for Vantage app, but every time I scroll up, the new message just brings me back to the bottom of the chat. So if you had a question for me on the Vantage app and I didn't see it, I'm so sorry. That's all I have for you guys today. I will catch you guys next week. Merry Christmas and happy holidays. Enjoy the rest of the year. I hope you have a fruitful 2025 and then we can start next year with a bang. Think the next time I see you guys is on the 30th. So I'll see you guys one more time this year, and then the next time I see you guys will be next year. Okay, bye everyone. Take care. Happy holidays. Bye. Take care.